A Canadian man grew his TFSA to over $617,000, completely legally, or so he thought. Then the CRA sent him a bill for $288,000 in back taxes, and the tax court sided with the CRA. This is a true story, and it could happen to more Canadians than you think. Today we're diving into one of the most misunderstood risks in Canadian personal finance, the possibility that the CRA could look inside your TFSA and decide that what you're doing in there isn't investing. It's running a business. And if they make that call, every dollar of tax-free growth becomes fully taxable. We're going to walk through real court cases, the exact criteria the CRA uses, where the legal line actually sits, and what you can do right now to protect yourself. Whether you're a passive index investor or someone who trades a little more actively, you need to understand this. Let's start with the actual cases, because this isn't theoretical. The CRA has been auditing TFSA accounts for years, and they've won in court more than once. The case that got the most attention involved a day trader in British Columbia. He'd been actively trading stocks inside his TFSA, and over several years he'd grown the account to over $617,000. Now, that sounds incredible, right? That's exactly the kind of tax-free compounding the TFSA was designed to enable. But the CRA reviewed his trading history and concluded that he wasn't an investor. He was carrying on a business. The tax court agreed, and he owed $288,000. There was also a case involving a financial industry professional, someone who worked in the investment world by day, who grew his TFSA to roughly $1.07 million through options trading. The CRA assessed him on nearly the full gain. The court again sided with the CRA, noting that his professional knowledge gave him an unfair informational advantage, and that the volume and nature of his trades constituted a business. Now here's what's important. In both of these cases, the account holders didn't do anything that felt wrong to them. They were just trading, using legal securities, inside an account the government created. So what exactly triggered the CRA? The CRA, it doesn't have a bright line that says, you made this many trades, now you owe taxes. Instead, they use a set of factors drawn from decades of Canadian tax case law to determine whether someone is carrying on a business. There are 4 that come up again and again, and you need to know all of them. The first is frequency and volume of transactions. How often are you trading? Someone who rebalances their portfolio twice a year looks very different from someone executing 200 trades a month. The CRA looks at total transaction count, holding periods, and the percentage of the year during which trading activity occurred. In one documented case, the taxpayer had completed over 2,800 transactions in a single calendar year inside their TFSA. That's a red flag. The second factor is intention to profit on short-term price movements. This is the distinction between an investor and a speculator. An investor buys a stock because they believe in the long-term fundamentals of a business. A trader buys because they think the price is going up in the next 3 days. The CRA will look at your average holding period. If you're regularly holding securities for days or hours rather than months or years, that's the profile of someone trading for a living. The third factor is knowledge and expertise. This is the one that surprised a lot of people when it came out in the court decisions. If you work in finance, as a broker, an analyst, a portfolio manager, the CRA argues you have professional knowledge that gives you an edge ordinary investors don't have. And they've used that argument successfully. It's not illegal, but it does make it harder to argue you're just a casual retail investor. The fourth factor is the use of leverage, options, or derivatives. These are instruments that are primarily tools of active speculation rather than long-term wealth building. If your TFSA is heavy in call options, puts, or margin strategies, the CRA views that as a signal that you're operating more like a trader than a long-term investor. None of these 4 factors automatically disqualifies you. But when you start stacking them, high frequency, short holding periods, finance background, options trading, you've got the profile of a case the CRA is very likely to pursue. So where exactly is the line between legitimate TFSA investing and running a tax-free business inside a registered account? The honest answer is, it's blurry, and that's frustrating. But let's try to define it as clearly as possible. The Income Tax Act in Canada does not prohibit active investing inside a TFSA. There's no rule that says you can only make a certain number of trades per year. What the law says, and what the courts have interpreted, is that if your TFSA activities constitute carrying on a business, the income from that business is taxable. The TFSA exemption doesn't apply to business income. it applies to investment income. So the legal question is always, is this investing or is this a business? And courts look at the totality of the circumstances. That means all four factors we just discussed, plus things like whether you have a systematic trading strategy, whether you devote significant time to it, and whether the activity resembles what a professional trader would do. Here's a useful mental model. Think about two different Canadians. Person A maxes out their TFSA every year, puts it into a portfolio of broad ETFs and maybe a handful of blue-chip dividend stocks, rebalances once or twice a year, and holds everything for years. Person A could grow a $1 million TFSA over a lifetime, and the CRA would almost certainly never look twice. Person B opens a TFSA, funds it, and immediately starts trading individual stocks daily, selling covered calls on their positions, flipping in and out of positions within days, and treating it like an active income stream. Person B might hit $400,000 in 3 years, and that's exactly who the CRA is looking for. The size of the account alone is not what triggers scrutiny. It's the behavior. A $900,000 TFSA built over 20 years of disciplined index investing looks very different from a $900,000 TFSA built through 18 months of day trading. All right, so you understand the risk. Now what do you actually do about it? Let's talk concrete, actionable protection. First, if you're a long-term investor, you're probably fine. Stop worrying and keep doing what you're doing. Buying ETFs, holding dividend stocks, contributing regularly. None of that is on the CRA's radar. The $95,000 in total TFSA contribution room available to someone born in 1991 who's been eligible since 2009 can absolutely grow into a very large account through completely standard investing, and that's encouraged. Second, if you do trade more actively, document your investment thesis. The courts have looked favorably on taxpayers who can show they bought a stock because of long-term fundamental analysis, not just to flip it. Keep notes. Keep records. If you can show the CRA that you researched a company, believed in its 5-year outlook, and happened to sell after a year because circumstances changed, that supports an investor argument, not a trader argument. Third, consider where you do your active trading. If you love trading options, short-term positions, or speculative securities, consider doing that inside a taxable account where the rules are clear. 50% of capital gains are included in income, and you can deduct losses. Counterintuitively, reserving your TFSA for your most boring, long-term holdings might be the smarter play. Let the TFSA shelter your index funds and your dividend compounders. Use your non-registered account for your more speculative activity. Fourth, if you're a finance professional and you do actively trade your TFSA, you should speak with a tax lawyer or accountant. Not because you've done something wrong, but because your professional background is a documented risk factor in Canadian tax courts, and you deserve proper advice about how to structure your activities and document your intent. Let's bring this together. The TFSA is one of the most powerful wealth-building tools available to Canadians, but it's not a total exemption from CRA scrutiny. If the CRA concludes you're carrying on a business inside your TFSA, every dollar of that tax-free growth becomes taxable. Courts have already upheld this position multiple times. The 4 key risk factors are high trading frequency, short holding periods,